Income tax 2020, rental property, passive activity limits. Come in, relax with income tax 2020. Residential rental property, passive activity limits. When thinking about the Schedule E with regards to our income tax formula, we're basically thinking about the income line up top. However, noting that we do have a separate schedule, the Schedule E, which in essence has an income statement on it, having income and expenses, in essence, the bottom line of it, then net income in essence, rolling into the top line of our income tax formula, where we then apply out our adjustments, above the line deductions, below the line deductions, to get down to the taxable income. With regards to the 1040, we're looking at line 8 on the 1040. We will have more examples in the actual forms and tax software where we'll spend more time on the forms, but just to get an idea, we're on line 8 on the 1040. That's going to be pulled from, in essence, the Schedule C. This is going to be the first half of the Schedule C, supplemental income and loss from rental and real estate. Second half of the Schedule C here's basically the bottom line that is pulling through to the Schedule 1 and then to the 1040. Remember that although we do have the Schedule E Form 2020, some of the information related to it, meaning the publication 527 and instructions for the Schedule E, are not updated for 2020 yet. We're going to be pulling some of that information from the new 2019 information, updating it where we believe applicable, but just realize that the base information is coming from 2019. And then you can get more information on this by going to the IRS website, looking up Publication 527 and instructions for Schedule E on the IRS website at irs.gov. 2020 information should be updated for those items shortly. So the passive activity limits. In most cases, all rental real estate activities, except those of certain real estate professionals discussed later, are passive activities. So once again, the IRS kind of imposed this on the rental property, because oftentimes rental property might be there for more well-off individuals possibly that have rental property and they're not really actively participating in it. In other words, basically they possibly have the rental property, they might have a management company, they may not be actively managing the rental property, and then they're basically collecting the rent on it without actively participating in it. And they're also, of course, holding on to it to think about the capital gains that could be increasing from the value of the property going up in value. And the IRS, being concerned once again about the losses related to these properties, considering that they can be extensive, have basically put in this rule of passive activity. So you're basically a passive activity for a rental property unless stated otherwise. And one of the exceptions might be that you're saying, hey, look, I'm a real estate professional. I'm not a well-off individual that's just holding on to this property to see it go up in value and having passive income on it, but rather I'm actually a real estate professional. This is basically what I do. Then that might be one exception to the passive activity kind of rules. So for this purpose, a rental activity is an activity from which you receive income mainly for the use of tangible property rather than for services. So we're not providing services in order to generate revenue. We have property, and we're thinking in this case generally the real estate type of property. For a discussion of activities that aren't considered rental activities, see rental activities in publication 925, and you can find that on the IRS website. So if you think there's an exception basically to the rule, you can look that up on the IRS website and get more detail about it. Deductions or losses from passive activities are limited. You generally can't offset income other than passive income with losses from passive activities. So that's the general rule for passive activities. General rule is we're not going to allow you, says the IRS, take the passive activity losses against other income. That's what they're concerned about. We may let you then carry forward the losses possibly and then take it against other passive income, such as other rental income that you might receive in the future. So then it says, nor can you offset taxes on income other than passive income with credits resulting from passive activities. So any excess loss or credit is carried forward to the next tax year. Exceptions to the rules for figuring passive activity limits for personal use of a dwelling unit and for rental real estate with active participation are discussed later. So that's going to be basically one of the exceptions. If you actively participate, may allow for some portion of the deduction, even though we still have the passive activity rules applicable. But then the general rule, if you have passive losses, then is that you have to carry forward the passive losses so that you can take them against passive income, and you're going to need then passive income at some point in the future in order to net them out against the passive losses to get a benefit from them. So real estate professional. So what does it mean to be a real estate professional then? Because we've seen then that real estate professionals might be able not to have the passive activity rules in the same way. So if you have rental property, what does it take to be basically a real estate professional? So you qualify as a real estate professional for the tax year if you meet both the following requirements. The first item, more than half the personal services you perform in all trades or businesses during the tax year are performed in real property trades or businesses in which you materially participate. And you perform more than 750 hours of services during the tax year in real property trades or businesses in which you materially participate. So if you qualify as a real estate professional, then the rental real estate activities in which you materially participate aren't passive activities. And if they are not passive activities, then you're not subject to the same kind of passive activity rules and limitations. For purposes of determining whether you materially participated in your rental real estate activities, each interest in rental real estate is a separate activity unless you elect to treat all your interest in rental real estate as one activity. So if you have multiple real estate items, then you're going to have to apply the rule of the passive activity rules to each to determine whether or not you are a real estate professional, unless you have them all treated as an interest in real estate as one activity. So don't count personal services you perform as an employee in real property trades or businesses unless you are a 5% owner of your employer. So if you're an employee in real estate services, that doesn't count unless you're a 5% owner of the employer. You are a 5% owner if you own or are considered to own more than 5% of your employer's outstanding stock or capital or profit interests. Don't count your spouse's personal services to determine whether you meet the requirements listed earlier to qualify as a real estate professional. So even though you're kind of one entity for taxes, when married, you can't basically use the spouse's, hours or whatnot to count towards whether or not you're a real estate professional. However, you can count your spouse's participation in an activity in determining if you materially participated. Real estate trades or businesses. A real property trade or business is a trade or business that does any of the following with real property. So develops or redevelops it. You're developing the property. Constructs or reconstructs it, acquires it, converts it, rents or leases it, operates or manages it, and brokers it. So material participation. So now we got the concept of material participation. The material participation then may give you some exception or some relief from basically the passive activity rules that could limit the amount of losses that you'd be able to deduct possibly against other income that was not passive. So material participation, what does that mean? Generally, you materially participate in any activity for the tax year if you were involved in its operations on a regular, continuous, and substantial basis during the year. For details on that, you can see publication 925. For more information, you can find that on the IRS website at irs.gov, irs.gov. You can also see it for the instructions for Schedule C. Participating spouse. If you are married, determine whether you materially participate in an activity by also counting any participation in the activity of your spouse during the year. Do this even if your spouse owns no interest in the activity or files a separate return for the year. So because you're married there, and that's kind of nice, you can have the spouse then counting towards the material participation, which might give grace in terms of the passive activity rules. Now, it doesn't do what you would like it to do in that it might not double the amount of losses that you could take if both spouses were involved in it, but it might allow for the qualification of material participation within the entity, within the married entity, the husband and wife entity, to take advantage or lessen the negative impact of the passive activity rules with relation to losses.